Homes are not affordable. I think we all know that. But what does home affordability mean? In this video, I'll talk about what makes a home affordable, how you can figure out how much home you can afford by giving you access to a free tool, common mistakes to avoid, and some tips to increase your affordability. So let's start off with what exactly home affordability is. That refers to the ability of someone or a household to purchase and maintain a home comfortably within their financial means. This is really important because understanding affordability ensures that you don't overextend your finances, leading to financial stress, or in a worst case scenario, foreclosure. There's some common misconceptions about home affordability, like just focusing on the purchase price and you're not considering other costs like property taxes, home insurance, HOA fees, the amount of maintenance costs, how much your utilities might be, and there's really so much more that goes into affording a home. Let's talk about some of the key factors that affect home affordability. First is your income and your employment stability. Having a stable income is essential to getting approved for a mortgage and, of course, to be able to make your mortgage payments once you buy the home. Your credit score and credit history are also important factors. Your credit score affects what interest rate you'll get and if you can get approved for the loan or not, and sometimes how much you can actually get approved for. Having a credit score around 620 is usually good enough to get approved for a home, but you may not get the best interest rate. To get some of the best interest rates, it's usually about a 740 and over, but just keep in mind that this is generally speaking. Everyone's situation is different and each lender has their own requirements. Don't worry if your credit score is below 620, there are still plenty of options out there for you like an FHA loan, and there's so much more. Another key factor with home affordability is your down payment. The down payment is important, especially nowadays, because essentially it reduces your monthly cost. We're starting to see an uptick in how much people are putting down for a home. I saw a report recently that said it was about 15% of the purchase price, and it was about 12% a few years ago. That may not seem like a huge amount of money, but when we're talking about $400,000 homes, that's a big difference. Not everyone has the ability to put a lot of money down on a home, but if they're able to, it could save them money in the long run. Another key factor is your monthly expenses. Your existing debt and your recurring expenses influence your home buying budget. You may hear the term debt to income ratio or DTI. This refers to the amount of money that you can spend each month to what your income is each month. There are many guidelines and rules of thumb for how much your DTI should be. Ultimately, it's up to you to decide how much you can comfortably afford. One common rule of thumb is the 28-36 rule. The 28-36 rule is a guideline used to determine your maximum mortgage amount. Your monthly housing costs, which include your mortgage, taxes, and insurance, shouldn't exceed 28% of your monthly income, and your total debt payments, which include housing costs, car loans, credit card debt, shouldn't exceed 36% of your gross monthly income. Because homes are so expensive right now and interest rates are so high, this rule makes it very difficult for a lot of people to be able to afford a home. Something to keep in mind is most lenders don't want your total DTI to be over 43%. So when you're approved for a loan, your estimated monthly mortgage payment is probably going to be over this 28-36 rule. So just because you're approved for a certain amount doesn't mean that you should pay that amount. Before you get really serious about buying a home, I think it makes sense to sit down and calculate what your affordability is and what monthly payment makes the most sense for you. I have an affordability calculator, the link is in the description. This is a free tool for you to use to figure out how much money you can actually afford comfortably. Now, for some people, once you fill out an affordability calculator, there's a bit of a shock to the system because you realize that it's really difficult for you to be able to afford a home. So what can we do to make it so you're able to afford a home more comfortably? One of the crucial steps in preparing to buy a home, in my opinion, is budgeting. For some people, this might be a no-brainer, but for other people, budgeting isn't our strongest suit. Also, with the price of everything getting more and more expensive, it's sometimes really difficult to keep up with your budgeting. I feel like every month I have to adjust my budget for certain items so I can keep on affording everything that I need to pay for each month. By making a detailed budget, you may be able to start to see areas where you can improve. It can be really difficult, but sometimes you might see that maybe you really don't need all those different subscription services because they can really add up. $10 to $15 here and there each month can add up to a good amount of money. So if you're able to trim down some of your spending, that might help with your home affordability. Even if you may not be able to buy a home right now, by trimming up some of your budget, you may be able to start saving for a bigger down payment when you're ready to buy a home. Building a strong financial foundation before buying a home is crucial. One strategy that's really helped me save money is having a dedicated savings account that automatically transfers money from my checking to savings each month. A major common mistake that I see some home buyers falling into is underestimating ongoing costs. Homeownership is awesome. It's also really, really expensive, or it can be. So this is what I mean. If something breaks, it has to be fixed. All those things can add up, especially if they happen one after the other, which I've certainly experienced, where it seems like each month there was a major component of the house that needed to be fixed or replaced. Another thing I've seen recently is the cost of property taxes and homeowners insurance going up. This can be extremely expensive in some areas, like where I'm from in Florida. Homeowners insurance has gone up for some people $500 or more a month. Now, just to be clear, this isn't going to happen everywhere, but you do have to think of things like that. Things do come up. Property tax can get more expensive. Insurance can get more expensive. Your electric bill might get more expensive. Especially when the economy is in the state that it currently is with inflation rising, it makes it more and more difficult for homeowners to keep up with all the rising costs that come with homeownership. Now, here are some tips to increase your home affordability. First is improving your credit score. Like I mentioned before, your credit score plays a big part in what your interest rate ends up being. So if you have what would be considered a lower credit score, let's say 600, most likely your interest rate is going to be higher than someone who has a credit score of 760. Now, sometimes you might only be saving 0.25% or something like that on an interest rate, but when you calculate that over time, and we're talking about a home that costs $300,000, $500,000, whatever it is, that 0.25% interest rate is going to be huge. So any little bit of money you can save each month will really equate to a large sum when we're talking about a 30-year loan. That's why it's so important to improve your credit score if you're able to. While we're talking about interest rates, it's also important to shop around for lenders so you can find the best interest rate. Another thing you can do is reduce your debt. Let's say you have some credit cards that have high usage. If you're able to start paying those down, paying more than the minimum each month, that can help you with reducing your debt. If you reduce your credit card usage, you could also be improving your credit score. Another thing that you could look at doing is having additional income sources. Maybe getting a part-time job, a side hustle, or maybe there are some investment opportunities that you could take advantage of. Now, I know this isn't going to work for everybody, but sometimes this can be a good strategy if you're trying to save for a down payment, or if you're trying to get more money so you can reduce your debt faster, things like that. Another thing to look into is homebuyer assistance programs. There are homebuyer grants and down payment assistance programs that can really help you get into a home and not have to pay as much out of pocket. By doing that, you might be able to save money, so then you have a little bit more savings, so if something comes up with the house, you can use that money for that. By taking a thorough look at your budget and your income, you can have a clear grasp on what your home affordability is. If you want to buy a home in a year regardless of housing market conditions, check out this video or this playlist about home affordability. If you have any real estate questions, my contact information is in the description below. Thanks for watching to the end, especially if you're a subscriber.